So what does Europe have to do in order to reassure investors that a crisis has been averted? My guest, Dennis Hynes. He's the chief market strategist at RW Pressprich and Company. Dennis, all right, you've been following U.S. equity markets. They seem to move based out of news in Europe. They were very happy yesterday. This accord, have you taken a look at any of the details?
Well, the problem is that there aren't any details. What I did, I'd seen everything that everyone else has seen, and I think what you find here is the resolution of the serious uncertainty that, at least for now, Europe will not be destroyed. I mean, that's really all we've really done here. Clearly, the argument would have been the most aggressive argument is that Greece should default, since everyone knows that they have no money to pay off their debts.
But Angela Merkel, the German chancellor, has basically taken that off the table and said, no, this is not going to happen. We're not going to let that, take place.
What that then means is that the leadership of the Eurozone is essentially saying we are kicking the can down the road without question. And so what does that mean? It means that there's no destruction in Europe for now. We're talking about Italy. We're talking about right behind that is Portugal and Ireland. So the fact is that nothing has changed except with the imminent destruction of Europe has been avoided.
Well, let me put it to you, though, because it seems as though something has changed, which is that the banks who hold sovereign debt, particularly of Greece, they are going to write that down to the level of 50 cents on the dollar. Now, who does that ultimately hurt? Not just the banks, but the customers of the banks, people that depend on those banks for loans and financing.
Yes, it hurts them. Okay, at the same time, it helps the process continue. The fact is that Argentina, when it defaulted, had 35% of the write-down, but there was still 35% left. Here we have Greece not defaulting, voluntarily giving up 50%, and at the same time, they're still, or they will be, by 2020, more than 8 years from now, they will still be at 120% debt to GDP, which means that in 8 years' time, they will still not be able to take care of their liabilities.
All right, well, before we get to 8 years, what should investors be doing, let's say, in the next 2 months? You still say that people should be selling into rallies in U.S. equities?
What did happen was I covered shorts the day after you and I were here, and then since then, with the close last week above this 1224 level on S&P, I put on an aggressive long position. But I must tell you that I'm doing it with a great deal of conservative or aggressive coverage. So the answer is the market's trading range. I believe that we've probably seen the extent of this rally. I think over the past summer, the past 3 months, we've had a trading range market with markets going down, trading sideways, then trading up, down 20% sideways, up 20%. This defines a trading range market, and there's no reason to believe otherwise going forward. Not only short-term, but long-term.
Trading range. But you're happy. You were long going into this rally this week.
Yes, I was. Okay,
right,
but it's very aggressive.
Peter, always a pleasure to have you. I want you to join the mix. Dennis Hynes, he got long last week. He made some money.
Wow.
In this week's edition of Bloomberg Businessweek.
Yeah.
You're making the case for people to take a look at the comparison between investing money by lending it to the U.S. government, let's say in terms of 10-year notes, 10-year bonds rather, or buying stocks. And the case is maybe you should dip your toe in the water and buy some stocks.
Well, what I was looking at was actually even shorter, like a three-month Treasury bill.
3 months. What is that?
It's 0.02%, or sometimes 0.00, and sometimes it's even gone negative. Point is that if you're putting your money into 3-month Treasury bills, it means you're extraordinarily risk averse. You're not taking any chance at all.
Basically.
It's like cash. It's like putting your money in a mattress. And you know how long it would take to double your money at 0.02%? It would take 3,500 years.
I don't have that long.
No,
I don't think
most
anybody
of
has
us
that
don't.
long.
So it kind of says, well, you got to stick your head out of the foxhole. Now, this is not a short-term recommendation. I don't know anything about what's going to happen in the next few weeks or months. But I'm just saying that over the long term, there is no way to earn what you're going to need for retirement by investing at 0.02%.
Dennis Hynes, come in on this, because I want to mention institutional investors, particularly pension funds and insurance companies.
Yes.
Now, they have computer models, and they take a look at the expected payouts that they're going to make to their various customers and clients. But when they look at the expected returns, traditionally, they've been looking at anywhere from maybe 6 to 8%, some even 10%. They're going to have to readjust that thinking Where are they going to get that extra yield?
They're not going to get it unless they take some serious risk. I agree with Peter. In order to get larger yields, you need to buy the Italian bond market. Okay, that's one place.
You buying any Italian bonds?
Yeah, absolutely. Well, the reason you're buying them is because
6% for the 5-year.
Yeah, of course it's an extremely high yield, but what you have is the moral hazard in Europe now. They're going to bail everyone out. So what you want to do is let them bail out Italy, should that occur. So therefore you're protected on your 6%. It's the country, the second country and third country after that. They'll make the same disastrous mistake that we did with Lehman, and then AIG comes in right behind it. So I'm talking about a temporary bet. There's no way that you can achieve a 6 to 8% return without taking serious risk. If you go out and try to buy the Treasury market, you're making a duration bet. It's a huge bet.
Explain what you mean by that, a duration bet.
What I mean is that if you take a 1 basis point move in the 3-month bill, that means it's nothing. If you take a 1 basis point move in the 10-year, it's $5. So 1 cent versus $5. Just multiply that, and the difference is huge. So you're taking huge risk by doing that. What people need to do is, in times like this, what they do is they reach for yield. Currently, we have an effective yield and the dividend yield of about 2.1%. Now, that looks really quite attractive. Now, in times of historic low yield, such as we are now, the forecast is that over the ensuing couple of years, you can expect subpar returns. For example, if you were to take a look from the period from 1925 to 2000, we've seen that the periods, if you enter the market, it's one of timing. You enter the market during a period of low yields, you can expect low yields to follow in the coming years. And the reason for that is that when you're in a historic low yield environment, there's no place up, there's no place to go except generally up. And the only time that will change is that as the devil is in the details, okay, the challenges that are facing the implementation of this program in Europe will suggest you'll have a chance to buy the long-term bond, okay, simply as the thing starts to unravel or as the details become very clear and pessimistically clear.
Peter H. Coy, what's the biggest impediment to people adopting this idea of taking these risks? Because if you look over the last 10 years, many people's stock portfolios, as measured by big indexes like the S&P 500, have done nothing.
Exactly. So I emailed Jeremy Siegel about this. I happen to be down
School of Business.
Wharton School of Business. He's the one who wrote Stocks for the Long Run. And I had just actually been down to Wharton last month and visited him. So he sent a very nice note. He said, if you look at the 20 years now, you're looking at 10 years. 20 years takes you back to the huge bull market of the 90s. If you put that entire span together, we're kind of in the long-term average going back 150 years. So we had a big up decade and then a bad decade. Overall, he believes that stocks are a good, in fact, an excellent investment for long-term investors right now.
He's been bullish on stocks for a while, though, right?
Well,
we got to just mention that as well.
But for the long term, he hasn't been disproven.